Hey everybody, welcome back to the Financial Freedom Show. One day I wanted to just say my name is Warren Buffett. I don't know, but that's kind of weird, really. Anyway, it's Rob Berger. Name hasn't changed since the last show. I guess I could officially change my name to Warren Buffett, but that would really be weird. And I don't know that my wife, probably wouldn't like that. Anyway, if you can hear me and see me, give me a thumbs up. And I already see a ton of questions, and they're great. I've been reading them ahead of time, and I will cover them. Remember, if you want me to discuss a topic, tag me in it. If it's just chit chat, friendly, of course, between folks watching. Thanks, Tyler, for the thumbs up. You don't need to tag me. But if you have a question you'd like me to respond to or a topic, I do have a couple just to get the show started. I've been asked a number of times about value stable funds is what they're called. Stable value funds, value stable funds. I don't know. And what these are, they're basically short to intermediate term bond funds that, much like a mutual money market fund, the NAV, the net asset value per share, is always set at $1. At least all the ones I've seen. Maybe there's some exceptions. I don't know. And they're sort of guaranteed against a downturn. And you say, well, how do they guarantee it? Well, they use insurance, right? And so as a general rule, whenever I hear that, I kind of get nervous. Whenever someone says to me, I've got this way to protect your downside, I hold on to my wallet because I have a feeling it's going to cost me a lot of money. And that's true when my friend texts me and says I should be buying puts. Like, well, that costs money. Or I should buy, an exotic annuity. That costs a fortune, right? Well, I don't know that these funds, they certainly are more expensive than, say, a comparable bond fund. I'll show you some examples here in a second. I can't say, though, I wouldn't lump these in with bad ideas like I would an exotic annuity. And by exotic, I mean like something that's, purportedly tied to an index that protects your downside. The problem with protecting the downside is it costs something, right? And often the cost is a limit to your upside. Now, in the case of these funds, a stable value fund, they use insurance products, right? And so one person that emailed me about this, let me show you the fund that he has. And these are typically available in retirement plans. I don't know if you can buy these, like maybe there's some out there, I don't know, that you can just buy on your own. But anyway, so this is a Fidelity, obviously a fund, and you can see the NAV, $1 per share. And I looked for the duration of this fund, and I'm sure it's somewhere. I guess if I went into the short, maybe some of their documentation, but I couldn't find it in just their description. Even when I went to composition, this is what you get from Fidelity on composition, bupkis. But in any event, I looked at another one from Vanguard. Again, this is part of their institutional portfolio. So again, this is not the kind of thing you'd go out and buy on your own, but it might be available to some of you, in a 401k or whatever. And you can see their benchmark is the 3-month U.S. Treasury bill index. Remember, Treasury bill, they have bills and bonds, and the bill is just for maturities under a year. They call it a bill. And one of the things I looked here, we do get a sense of duration. Here it is, 3.1 years. If we look at fees, where'd it go? Expense ratio, it says note, but when you click on that, nothing happens. So I had to dig into the details here. It's 44 basis points, right? You compare that to, let's just say, their short-term bond fund, which has a duration, I think it's a tad less than 3.1 years. I think it's like 2.7 or something. Yeah, 2.7 years, but so it's close. The fees on this one is, I think, 5 basis points. And so that's the first thing to note about these stable value funds. They're more expensive, right? Now, of course, I suppose if your return is either there's much less volatility, right, because of the insurance wrapper, if you will, and or long-term returns are even after fees better. This might be an alternative. I kind of view stable value funds as a potential alternative to like either a money market fund or other really short-term bond fund. I don't really view them as an alternative to an overall bond portfolio where you might have whatever 50% in tips, say intermediate term tips, and 50% in some sort of intermediate term aggregate bond fund. And when I compared the returns, like this is the one that the viewer emailed me about. So this has got a 10-year return of, I don't know how well you can see that, but it's 1.59%. The Vanguard short-term bond fund, price and performance 10-year, I think is a tad higher, not by much, 168. And I suppose you could say this probably has more volatility. But that's kind of how I view these funds, as sort of, I suppose, an alternative to a short-term bond fund. Now, you may have access to some of these in your retirement account that have some sort of yield, guaranteed yield that's higher than what we're seeing here. This, we look at it, it's over here, it's 1.13. The Vanguard one is about the same, I think. 1 year, 133. That's the returns, though. It's roughly the same. I saw it somewhere. So, I look at these funds as, for me, I just don't see a need for them. And to me, I'm really working on simplifying my portfolio, something that may come up in today's show, because I'm going to be doing a couple of things to my own portfolio. So for me, I just don't see a need for this. But I can't say that it's necessarily a bad investment product, depending on why you want it. But I don't really see it as an alternative to sort of an overall, if you follow sort of an intermediate term overall bond portfolio strategy. Because long term, at least the funds that I've seen, they're not going to compete with intermediate term bond funds. Now, I suppose you could say, well, but we've got a rising rate environment, so I just sleep better at night with this kind of fund. And I can't argue with that, but it could long term, affect your overall performance. But who knows? If you look at this one, it's since inception, you can see here, it's 439 basis points. Of course, this was started in 1989, so that was to a very different interest rate environment. So anyway, that's my take on stable value funds. That was the first thing I wanted to show you. The second thing, someone sent me this. So the 4% rule, we keep going back, we being the financial community, retirement community, keeps going back and forth on the 4% rule. Wade Pfau, who is done a lot of great work in the whole retirement space, he says the 4% rule might not work going forward. And someone showed me this article, which you can Google. This comes from Barron's. The 4% rule might not work. Well, first of all, I think that's true always and forever. The 4% rule might not work at any particular time. I mean, basically, all the 4% rule, and they've adjusted it, Bengen has maybe adjusted it to 4.5 or so with some different asset classes like small cap. But all the rule basically says is, let's go back in history and find the absolute worst time to retire as measured by, will your money last for 30 years? What's the absolute worst? And it's, I think around 1968, but the late 60s, that's the worst so far. And if that's when you retired, you could take out in year one 4 to 4.5%, depending on how you invested your money, and then adjust that for inflation, and it would last 30 years. So the real question is, well, could 2022 be the worst? Could it trump 1968? Well, of course it could. For all we know, it may turn out that, I don't know, 2019 was the worst time to retire. In a couple of decades, we'll know. But his point in the article was that, and I'll show it to you, not that you can probably read this, and I unfortunately can't make it bigger. First of all, he says he thinks 3% is a lot more realistic in terms of giving the same chance of success. And part of the reason was interest rates. But the thing, and I don't know if he talks about it in this article, I didn't see it, but I could have missed it, is inflation, right? I mean, the reason the 60s were such a poor time to retire wasn't because the stock market went down. It did. There were two bear markets, in the 70s. But of course, the market in 1929 for the next, so many years was much worse. It was a combination of a bad market and inflation. So, we've had inflation's ticked up after COVID, and I don't know if it's transitory or what, but it's been pretty low. We'll see if it goes back down. But the other thing that I think it misses is I really don't. I see 4% rule as a good planning tool, and I even used it in my book, Retire Before Mom and Dad. But I don't see it as actually a good way to figure out how much you should spend each year, because it's blind, right? It's like, if you think about it, think about the 4% rule. So let's say someone retired. Let's say there are two really good friends, and they're both at retirement age, two couples. And one couple, and they both have, we'll just say $1 million. And one couple retired at the end of last year. And they took the $1 million and, okay, 40,000, year one, that's easy. And the second couple retired a day ago. Well, they're no longer at $1 million. They're at a lower number. And so even though they retired a couple of weeks apart, their starting number's lower, right? Because their portfolio's down, probably. And you think, well, I get the math, but that just seems kind of odd. And in fact, let's imagine that the second couple doesn't retire now. They wait a year. They wait to the end of this year. And during this year, the couple that retired in December, we have a really bad year, and both their portfolios go down. They were both at $1 million, and they both go down to 800,000. Well, the couple that retired a few weeks ago, what are they going to take out? Well, 40,000 plus inflation. What's the couple going to take out that retires a year from now? Totally different number, right? Because they're just starting out. So it'll be 4% of 800 grand, 32,000. That just doesn't make sense, right? And so the other thing about the 4% rule is, we talk about success, and if it lasts 30 years, success. But what gets glossed over is that even for some of those successful years, the portfolio could have almost bottomed out like at year 20. It's just like a plane nosediving right for the ground. And maybe because of the market, at the last second, it scraped almost at zero and then took back off again. And it got to year 30, and we put that in the success column. Well, that's, I suppose, great from an academic perspective, but I don't know. Do you want to live through that? I sure don't. We wouldn't just put blinders on and ride the plane to 100 feet. It's just, I don't think. So that's why I like the guardrail idea. And there's different guardrails. We've talked about it. I've yet to pick what guardrails I would use. And I don't know that I'll have to, because I don't think we'll get near 4%. So there's another approach. Don't take out that much. But I recognize that's not everyone's situation. All right, so that's the second thing. The third thing, and this is quick, and I'll get to your questions. Did you see that UBS bought WealthFront? So WealthFront and Betterment, I think, are probably the two, right? The two most prominent robo-advisors. And I was actually talking about this, I think, in a show a week or two ago, like what's their exit strategy? And so, yeah, they got bought out. I expect the same will happen to Betterment at some point. I don't know, by the way, if that'll be good for WealthFront or bad. I have no opinion on that. I think WealthFront is a good, if you want a robo-advisor, I think they're good. I think Betterment's good. But I just thought that was interesting news. Oh, I do have one other thing I want to show you. Someone sent me this page. I'll show it to you. It's on the Bogleheads forum. It's ETFs versus mutual funds. So if you just Google ETFs versus mutual fund Boglehead, you'll get to it. But the reason I like it is, or mention it, is there's a section on Vanguard funds and how they structure their ETFs and why their mutual fund, their index funds, mutual funds, haven't distributed capital gains, and why you can take a mutual fund and convert it to an ETF. Basically, as I understand what they're saying here, their ETF is just another share class of the fund, which is kind of interesting. And apparently, they actually patented whatever it is they do, which expires in 2023. You might find that interesting. I will say this. I get the whole, I litigated patents. In fairness, I litigated one design patent. and it had to do with a hook that hangs up pictures. So not exactly cutting edge technology. Oh, that's not actually. I had another patent case that had to do with the BIOS of a computer. That was fun. I went all the way back into the days of the first PC, trying to understand the basic input-output system. I'm not sure I ever did. In any event, it kind of bothers me that Vanguard patented it because it just hurts other investors that aren't at Vanguard. I mean, I get the whole competitive landscape thing, so maybe I'm just being naive. All right, enough chit-chat. Stephen asks, when in early retirement and doing quarterly withdrawals, when would you make the switch to take from bonds and hold off on stocks when they're down? Percentage of total portfolio amount or market? Well, I tend to take from dividends and interest first, right? At least, excuse me, at least in a taxable account. I suppose if I were selling shares, whether in a, taking money out of a retirement account or otherwise, I might look at my allocation. So it depends how often you rebalance, partly. But let's just say you rebalance once a year, but you take money out quarterly. Because you could rebalance quarterly, and then it wouldn't matter where you took it out of, right? Take it out of whatever asset class you want, and then you just rebalance, and you're back to whatever you would have been in. It doesn't matter where you took the money from. But if I were going to only rebalance once a year, let's say, I probably would look at whatever asset classes were above my target. There's always going to be something that's above the target, and take from there, just as a way of kind of rebalancing quarter by quarter. But I'd always have to be mindful of taxes. See, and that's the tricky thing. And actually, this, Steve, actually is a good question because it brings up my situation. Anything that brings up my situation, it's all about me. So I think that's a good question. Speaking of me, I'm up to like 42,000 subscribers. Apparently, if I get to 100,000, I get this plaque, which I think is now my new goal in life. So you need to subscribe early and often. I'm trying to think, most cool YouTubers, when they get the plaque, they strategically put it behind them to remind everyone who watches their videos that they have 100,000 subscribers. So I don't know, would I put it in replace of my wife's picture behind me? That doesn't seem like a smart move to me. Anyway, so what was I talking about? I have no idea. So when you retire and you're dealing with withdrawals and taxes and Social Security, do you do Roth conversions? Medicare is going to cost me how much? I thought it was free. The whole investing thing gets 100 times more complicated. And this whole kind of question, Steve, that you bring up is just one aspect of that complication. And so one of the things I'm doing is working on simplifying my portfolio. Actually, I have a video that I've already made that I'm going to publish tomorrow where I look at someone's portfolio that an advisor set up for them. It's 11 funds, and I walk through how I would think about simplifying it. Well, I'm doing that in my own case because I want to make rebalancing easier, and I have to juggle taxable, traditional, and some Roth, and that makes it more complicated. One of the problems that I created for myself was that when I had a lump sum to invest after selling my business, I decided to make 100% of my US stock allocation, I put it in my taxable account. What that means is that if I want to rebalance by selling, I've got to trigger capital gains. Now, maybe what I do is just wait for the market to crash, and that'll take care of the rebalancing for me. Done and done. But I have REITs, of course, in a retirement account. And that's 10% of my overall stock allocation. And so I've been thinking for a while now, and pardon my cough, still can't quite get over it, getting rid of my REITs. I've had REITs for decades now, but it's not like I'm wedded to them. It's not as if I think, you've got to have a separate allocation to a REIT fund or, the world as we know it's going to come to an end. And if I convert that 10% of REITs into other things, it wouldn't be all US stocks, because remember, I want to rebalance. So some of it would probably just go into bonds, but some of it would go into US stocks. And then I have some portion of my US stock allocation in a retirement account, and I can use it to rebalance as needed. So that's I don't know if that's thinking outside the box. That probably gives that too much credit. But yeah, that's what I'm thinking. I'm even thinking about ditching my emerging markets and just putting that allocation just into total international, like a VXUS, which includes emerging markets. So it's not as if in both cases, I'll still have exposure to REITs and exposure to emerging markets. I just won't have as much. And do I really care? So I haven't actually pulled the trigger on that. I'm pretty confident I'm going to. I was waiting to get rollovers done. By the way, so I did a rollover, as you know. I used Capitalize, and I think I've mentioned, they sent me this free envelope with addressed, and you can't see the address, but it's on there to my broker. But they also sent me an email, and they said, you don't actually have to mail your rollover checks that you receive from your 401k to wherever you've got your IRA. If your IRA provider allows mobile check deposit, you can just snap a picture of it. And I'm thinking, well, I do that with a bank account, but it's made out to me and I sign the back. This is not made out to me. This is made out to Vanguard or Schwab or Fidelity, for my benefit, but it's not made out to me. So I just figured Capitalize, they don't know what they're talking about. But then I tried it, and not only does it work, but they even, in the app I was using, when you get to the point where you take a picture of the back of the check, they actually say on there how to sign it. And it was, for deposit only, name of the broker. And I deposited them, and they're in my account just like that. I thought that was pretty cool. Okay. Marv, in my home, my internet connection is protected by a firewall. In a public place, I was told that I need to use a VPN. That is correct. Well, that's the smart thing to do. Now, my latest information is that the closed padlock icon on the left in the address bar protects me. Do you agree with the closed padlock on the address bar protects the user? Well, let me first say that I'm not a cybersecurity expert. I know many, not many, I know several. And I know some who are serious cybersecurity, military grade experts. And they tell me to use VPN. Now, I will say that what I'm not going to do at Starbucks is log into my brokerage account. I don't care what I've got going. That ain't going to happen. By the way, they even say use it at home. And the reason is it keeps your internet service provider from collecting data on your traffic. And it's not, it's just a general, like, who do you want? Basically they sell it, right? I don't know. I don't have it running right now. So maybe, I don't know, maybe I'm not sure what'll happen. Fast Eddie says, good morning, love the channel, enjoy the day. Thanks, man, appreciate it. Okay, Mike, where would you store $200,000 for a future home purchase? It would be in a taxable account. Money market would get eaten by inflation. Stocks would be perhaps too risky. Bonds would generate income. Well, the first question would be, when are you going to buy the home? If it's 10 years from now, I might put it in some sort of balanced fund. If it's 2 years from now, I wouldn't. I might even put some of it in I bonds, oddly enough. Unfortunately, it's $10,000 a year per Social Security. So if you have a significant other, going to be 20 grand. If you're 200,000, maybe I wouldn't. Maybe it's not worth the hassle. Of course, it locks away for a year, but presumably you're not buying the home in the next year. But if you were, then that obviously wouldn't be an option. But it kind of just depends when you're going to buy the house and how flexible that is. Meaning, if you want to buy it in 3 years, but if you had to wait a year or two, you could, such that if whatever you put the money in went down, you could wait a couple of years more and not regret it. I might take a little more risk, but it's hard to answer that in a vacuum without knowing when you need the money. But if it's in the next 2 or 3 years, probably wouldn't be much more than a money market fund, not with where valuations and interest rates are right now. Yeah. I mean, maybe you could risk it on an intermediate term bond fund. Of course, they're now saying the Fed might raise rates 5 times this year. Andrew, good morning. I love California. One of my favorite trips was down the coast. We went to wine country, and then over the course of a week, drove all the way to San Diego. My favorite stop was near, now I'm not going to remember. Oh, Carmel, right. It was gorgeous. We stayed at this hotel. I don't remember the name of it, but it's phenomenal. And then I went to a conference in San Diego. It was a lot of fun. Good morning from Seattle. Hello, Justin. Love Seattle. I had a case in Seattle. We didn't try it. I'm trying to think, where did we have the trial? So this was the coolest thing. I represented a railroad. Any of you ever go to Alaska on a cruise, and there's a stop in a place called Skagway, where you get out and you get on a train, and for what I'm sure is $1 gazillion, they take you up the mountain and back? That railroad was one of my clients. The downside is, well, I went to Alaska a couple of times. I was only there in February. It was always February. Of course, the train doesn't run in February. Nothing runs in February. I was actually in Whitehorse, which is in the Yukon territory of Canada, in February. I fly in, so they have jets that go into Whitehorse. Skagway, when I flew in the first time, we flew to Juneau. Well, we flew to Seattle by jet, of course, and then into Juneau. But then we got in like a 4-seater plane. I'm literally right next to the pilot. And we fly first to Haines, Bald Eagle Sanctuary there, which is pretty cool, and then to Skagway. That was a wild trip. Anyway, when I was in Whitehorse, I flew in by jet. I rented a car and I drive to the hotel, and it's like 40 below. It's when Fahrenheit and Celsius are the same. And I pull in and I get out of the car and I'm looking at the front of the car, and like right where you pull in, there's an outlet in front of every car. I'm like, that's the weirdest thing I've ever seen. What's that for? I go in, go to bed, get out the next morning and have to go somewhere, click. And I look out and I'm like, each car is plugged into an outlet. What is going on here? Well, oil freezes apparently at 40 below. Who knew? So I got snowed in for like 4 days because the plan was to drive from Whitehorse to Skagway, which is like driving across the surface of the moon, at least for a good chunk of it. I had nothing to do. And I thought, well, I'm going to go to a movie. And it was in the middle of the day. It's 40 below. I could actually walk to it, but it wasn't far because if it were, I would be dead. And I'm thinking, I'll be the only one there. Place was packed. I just guessed, in the dead of winter in Whitehorse, there ain't a whole lot to do. Okay, this show is going off the rails. No pun intended. You see what I did there? All right. Andrew, is anyone still watching? There's a few people. Okay. Could you make a separate video comparing the difference between, say, a 70-30 versus 100% stock in retirement? The dips are difficult, but 100% seems to recover better afterwards. Well, I suppose I could do a video, but let's just talk about it. So we know long-term, if history is any guide, that a 100% stock portfolio will do better, right? Long-term. The problem is it's a lot more volatile. And what I would suggest is you read Bill Bengen's original paper, even if you don't follow the 4% rule, and I don't think most retirees do. Because what he said was, look, if we want the money to last for 30 years, the best range for stock is 50 to 75%. And why is that? Well, when you get to 100%, if we go through a 1929, for 3 years, we lost 90%. It just crushes it. Now, I suppose you could say, well, I'll take the chance that happens. Hopefully it doesn't. It's up to you. But that would be my concern. I actually think 70-30 is a pretty good allocation. You have to balance. See, the problem that you probably have with the 70-30 portfolio is what you're missing out on, right? And you're sacrificing some long-term gain to protect against a short-term market that just gets decimated. That's what you're doing. But to me, the goal isn't to maximize your returns, because in some ways, there's no way to even do that. I mean, we won't know if we've done that until it's too late, right? The goal is to have money to live on in retirement and not lay awake at night, in a cold sweat worrying about your portfolio. Now, that's going to result in different portfolios for different people. Plenty of reasonable answers. The extremes are usually not good. So That's my take on the 100% portfolio. By the way, we could put it in something like Portfolio Visualizer. Actually, let me just show you that, just so you can do this on your own, really. This, by the way, is the portfolio that I was looking at that will be in the video tomorrow. Anyway, that's not why we're here. One of the things you can do, and let me just see if I remember how to do this. We'll do VTI 100%, and then we'll add in B and D, and then for the second portfolio, we'll do 70 and 30, right? So if we analyze, so if we analyze this, and this goes back to 2008, so that's fine. Well, obviously the 100% stock portfolio is gonna beat it, and it's, we could actually, let's change the initial investment to say $1 million. You're retired, you got $1 million in January of 2008, and so obviously I shouldn't say obviously, there could be periods of time, and there are, when 100% stock portfolio will underperform a portfolio with some amount of bonds in it. But in any event, it beat it, right? But the one thing you can do here is cash flows. You can say, okay, I want to withdraw a fixed amount. So you could use the 4% rule. Inflation adjusted, I would say yes. Withdrawal frequency annually, fine. And then you actually, well, it is. That's not true. 400 grand's no money. That sounds like the dumbest thing I've ever said. I'm sure I've said things that are even more dumb. In any event, the other thing you could do, by the way, I've used specific investments, but if you go over here and go to asset allocation, instead of using investments, you can just use asset classes. So we'll just say US stock market, 100%, and then we'll do US bond market. Where are the bonds? Fixed income. Total US bond market. And then we can do a second portfolio just like we did before. And we'll start with $1 million, and we'll take out a fixed amount. The reason I come over here to this, and we'll analyze it, this goes all the way back to 1987, right? Now, excuse me, obviously a big difference, but of course, you're talking about 35 years. The thing you can do now is just try different years. You could say, well, what if we started in 2000? What would that look like? I don't know how well, that's interesting. Look at this. You start in 2000. Look at that. 70-30 beats out. I wouldn't have guessed that. I know that the first decade was not good for stocks. It's basically flat. So that probably explains it. Wow, that's pretty powerful, actually, I think. But again, we're still cherry picking a time period, right? So if I came in here and said, well, let's just pick a different time period, we'll pick, it doesn't have to be a big difference. Let's pick, I'm trying to think when stocks turned positive. Was it 03? So look at that. We just changed it by 3 years, and bam, we're back on top, baby. 100% stocks. So I don't really know what the conclusion is one should draw from all that, but you can play with that. That's all free. I'm not logged in. I have a paid account, so it gives me a few extra options, but that was all on the free account. Yeah, I personally would not be comfortable at 100% stocks, and that's true even though my withdrawal is a lot lower than, or will be a lot lower than 4%. All right, Justin, why do you think managed funds with way higher fees than index funds are still so popular? That's a good question. I would say generally, I think it's a couple of things. I think one of it is a fear of missing out. If you invest in the index funds, you're sort of relegated to, it's interesting, people say average returns. Actually, that's not true. If you buy index funds and stick with your approach for a long period of time, you'll actually do better than average, because most index fund investors don't actually get the return of the index because they're popping in and out. They're scared, they're selling, they're greedy. They change their stock bond allocation when the market's up, right? But I think there's a fear of missing out. And I think there's a fear of standing still. We like action. We're sort of prone to take action. And index fund investors have to just, don't do something, just stand there, right? At least if you're a good, the thing, keep in mind, by the way, you can be a very active investor with index funds. You can be a very passive investor with individual stocks. But in any event, I was listening to the Money Guys show, another YouTube channel. Love them; they're great. And they were showing a Dave Ramsey video where a caller came in and basically called Dave an idiot. That wasn't the word. Maybe stupid was the word, because he promotes actively managed funds over index funds. Well, it was an interesting video. One of the things Dave said was, look, I got no problem with index funds, and I think you can get rich on index funds. I know he said in the past, it's easy to beat the indexes. All you got to do is look at the history of the funds that have outperformed the index and pick them. And that's where he and I disagree. And I think I've got his views correct, but obviously I'll let Dave speak for himself. Maybe I've either misunderstood him or not conveyed them correctly. You certainly can look at funds that have beat the index, even over, say, a decade. So I was looking at the SPIVA reports recently. Is that how you pronounce it, SPIVA? SPIVA? It's the Dow Jones, SPG Global. They do reports. And I think over the last 10 years, roughly 85% of actively managed U.S. large cap funds. Oh, here it is, 82.5%. Let me show it to you. So percentage of large cap funds right up here that have underperformed the S&P 500, 82.5%. 17.5 have beat it. The problem is we don't know that those 17.5, even if we pick them, will beat it going forward. And in fact, I think they're less likely to beat it, because what happens, you can look at ARK, which is not in that category. It's already underperforming. But, it had a big banner year. So what happens? Money goes flooding in. And the problem that Cathie Wood had was she had too much money to invest. Frankly, she probably would have been better off closing the fund. You have all this money to invest. And so what do you do with it? Well, in her case, she bought overpriced companies. Now, some would say she was buying overpriced companies to begin with, and that's sort of her strategy. And she would argue they're not overpriced. Fine. But it creates real problems for funds. And that's why you see the funds that are top, 1 year or some 5-year period or whatever, tend to not be the top and often are towards the bottom subsequently. So it's very hard. It's impossible to say, well, which funds are going to outperform. But some people are afraid to miss out. They're constantly chasing the next new thing. Scott asks, are there any brokerage houses that warn investors when changes take place, like the minimum investments in various share classes, changes in investment strategies before the event takes place? Not that I know of. There could be, but not that I know of. Now, if you're invested in it, you might get fund literature that tells you this. You just have to actually read it. And sometimes it can be a bit overwhelming. Nicholas, welcome. I got someone from Chantilly, Virginia. That's in my neck of the woods. Philip. And by the way, this is a non-financial question or comment, and I welcome them. History, chess, fitness. I've been really deep into cars, rails, pails. Some of you will know what that is. A lot of functional training. That's what you do when your shoulders start to not work like they're supposed to. Anyway, Philip. Rob, fascinated by your interest in presidential biographies. Best one so far in your quest. Are you still old school in buying and keeping hardcovers? So I am old school. I have some soft covers, paperbacks, but most of them are hardcover. I read the Chernow biography of Washington, and that was actually on Kindle, but I prefer hard copies. Let me show you something. Bear with me. This is my 4-set volume on Lyndon Johnson. The Path to Power, The Passage of Power, Means of Ascent, Master of the Senate. This will take me a decade to read. In terms of my favorite, I really liked Monroe, which is in the other room, and I really like John Quincy Adams so far. I know, like with Hamilton, which I read, Chernow was very well known and popular. His writing style is not my favorite. It's interesting to compare them and read them in order. So, like when you read Monroe, so Monroe, before he was president, went to Paris to negotiate the Louisiana Purchase. And when you read the Monroe biography, he did a really good job. But there was a problem at the end of his diplomatic time in Paris. The big issue, of course, was Britain versus France, right? Of course, Russia was involved, but and a treaty with Britain, and then how does France react to that? And but when you read Madison, Monroe was a disaster in Paris, horrible. The Monroe Doctrine. When you read Monroe, the author actually points out, some would claim that Madison had something to do with this, but not really. Or was it Madison? Or John Quincy Adams. Excuse me. I think it was John Quincy Adams. The Monroe biographer says, no, it was all Monroe. Come on. What president would delegate that kind of important thing? But when you read John Quincy Adams, I think he got all the credit. Anyway, we do the same thing today, right? Who gets credit and blame? Who should get blamed for inflation? Don't answer that. This is not a political show. I don't care what you think. Well, that's not true, but I'm trying to keep this friendly. All right. Displaced Hoosier, good morning from Southern Florida. I'm jealous. BJ, good morning from Ann Arbor. I still love you. I don't know why you live there, but I get it. Someone has to live there, I guess. All right. And VJ has a question. Can you please show what indicators you look for with individual stock investing? In your words, playing craps at a casino. I didn't call stock investing like playing craps in a casino. I enjoy craps at the casino. I talked about my crypto investment, which is minor. And by the way, getting smaller every day as like playing craps. I've been following Int'l, itching to invest. Well, I don't look at indicators really. I try to buy things that I think are good companies at a valuation that's less than what I would view their intrinsic value, meaning the present value of their future cash flows. And I tend to wait until I think I have. There's no sure thing, but where there's a real discrepancy. So I bought banks a year ago. I'm not buying them now. I bought Apple in 2013 and again in 2018 and 19. I'm not buying it now. Doesn't mean I think it's a bad investment. I still hold it. But it's not the kind of investment where I have the utmost confidence. By the way, they're releasing earnings this afternoon, right? After the market closes. And sometimes, like with Apple, I remember doing this cash flow analysis and thinking, this is when the stock had fallen from 700 to like 395. And I'm like, I don't even understand what people are thinking. I mean, you could assume no growth. This company will not grow, and its cash flow justifies, a higher price. I guess some could say, well, maybe its growth will go in reverse. Maybe the next iPhone's a bomb, and people stop buying it. I don't know. It seemed like a reasonable choice. So with the banks, I didn't even really do that. It was like, I think their capital situation is strong following the Great Recession. They were both trading below book value. If interest rates go up, they'll benefit. And that was about that was about it. It's probably not very satisfying. Alexander, great show. I would like your thoughts on buying stocks the year or so following their IPO or SPAC-merger. I will buy RKLB, but I feel I should wait. Let the dust settle. Well, I don't even know what RKLB is, but let's find out. RKLB. Rocket Lab USA. Well, they've got a great name. By the way, I don't really focus on IPOs and, reverse mergers or small company going public via SPAC. I don't even really analyze them. Here's the company. I don't know a thing about it. Rocket Lab USA. You can look at key ratios, see they don't have any. Is this maybe it's brand new? Maybe that's your point. Yeah, I mean, I would have to, I wouldn't, so to me, I wouldn't even analyze this company. It could be a great investment, but when did it go public? Let me see if I can figure that out. Rocket Lab USA, when did it go public? Oh, August of last year. Yeah. Could be a great company. I don't even know what it does. Should I know this? Am I living under a rock? Oh, it launches satellites. So I can tell you right away that I would have little comfort because I just don't know that industry. I wouldn't even know how to evaluate that company. So it just wouldn't, it's outside of my area of expertise, and most companies are. I just don't know the industry. I suppose if it were important to me, I could dive in and try to learn it. But yeah, sorry I couldn't be more helpful. Good morning, Rob. Which bond fund, this is from Quincy, should I hold in my HSA? I choose the Fidelity US Bond Index. Thoughts? Well, my first question would be, are you spending your HSA money each year, or are you saving it for retirement? And at least initially, I would probably put equities in my HSA because of the tax benefits. Like I want my Roth to get as fat as a tick. I want my HSA to get, I wouldn't quite say as fat as a tick, because remember, it's only tax-free when you take it out if it's for qualified medical expenses. But I wanted to get fat enough to handle, our medical expenses when we're older, right? That's kind of how I think of it. So I probably wouldn't put bonds in it. Yeah. If I were going to put bonds in it, it would be just like I invest in bonds generally. Certainly, Fidelity U.S. Bond Index Fund would be perfectly fine. You might consider TIPS as well. Yeah. My approach, though, is equities and HSAs, at least for now. I suppose in theory, it could get so big that I think I don't, HSAs are not the best for inherited. I mean, if for an inheritance, you'd rather give your loved ones a Roth, I think, right? I think with HSAs, they have to pull it out, and maybe under the new law, I assume it's over 10 years, but don't quote me on that. I could be wrong. I know that's how it is for an inherited IRA if you're not a spouse of the deceased, you weren't a spouse of the deceased. And that's a new law, relatively, right? I'm guessing HSAs are the same, and they get taxed. I don't think, yeah, I'm pretty sure that's correct. And can they use the HSA for medical expenses and not get taxed? I don't think so. Inherited HSA. How do they work? And I mistyped about 5 words, but Google figured it out. If your beneficiary is your spouse, it becomes their HSA. That makes sense. If the beneficiary is your estate, or there is no beneficiary designated at the time of your death, the account will be changed to a taxable account in the name of your estate. The full value becomes taxable. Yeah, so they're not the best to inherit except by a spouse, at least according to MarketWatch. Dean, welcome. Another viewer from Michigan. Where are all the viewers from Ohio? That's what I'd like to know. I think there's an Ohio team playing this weekend. It's not going to be an easy game for them. That's another thing we could talk about is football. Rap Freak, welcome back. Can you describe how you view I-bonds and the place they fit in your overall investments? Are you long-term on your I-bonds regardless of rate? Well, so I'm in the middle of doing a number of things with my asset allocation. Stock bond won't change. I mentioned what I may do with REITs and maybe emerging markets. And I'm getting my bonds back to 50% intermediate term and 50% sort of nominal bonds. For me, it'll just be some kind of total bond fund, US. So I view I-bonds as part of the TIPS allocation. That's how I view it. I have mixed feelings about I-bonds. I think I've alluded to this. The problem is that they're a pain. $10,000 a year at a time, times 2 if you're married, I guess. But they're a pain. It's just that it's hard to pass up 7%. But will I hold them regardless of rates? No. But I could, just for simplicity's sake, eventually pull them all out and put them in tips, which is what I would do. If I pulled them out, they're part of my tips allocation. That's how I look at them. You can't track them in personal capital. You got to do it manually. They're not publicly traded. They're kind of a hassle. That's just what I'm saying. But I have them. Don't have a ton. Trying to think. It's a small percentage. The Martin something. I did hear back from Mark Zoril about coming on your show. Thanks to your recommendation in your book. I now use him as an advisor. Well, that's great. I've had to cancel on Mark twice. What I'm thinking of doing, so Mark, is an advisor that charges like a monthly fee, and it's very small. And basically what he'll do is he'll help you figure out what your asset allocation can be, what funds you should be in, and then you can go do it yourself. He'll help you figure out when you should take Social Security. Should you do a Roth conversion? Whatever. He does a lot with expats and folks living overseas, which was sort of the focus of my reaching out to him. We hasn't been on this YouTube channel, but I interviewed him on the podcast, the Dough Roller podcast, eons ago. But what I'm thinking of doing is doing a separate live show so that you guys can ask Mark questions. I might have my own. That's what I'm thinking of doing. I don't know what you think about that. Because here's the problem. And Mark could probably come up with all the topics, but when it comes to issues that those of you experience that live overseas, whether you're U.S. citizens and you've moved to, I don't know, Costa Rica to retire or whatever, or you're a foreign national, you came here to work, you've got a 401k, you go back home and you're like, what in the world do I do with this 401k? Or, how do I invest in Vanguard funds if I live in Vietnam, and do I worry about currency risk? And, the point is, I'm not sure I'm smart enough to know all the questions I should ask him. I guess you might say I just rattled off several, but I mean, that pretty much exhausts my knowledge of, the hurdles you face if you live outside the US. So I thought, well, if I do a live show, you guys can ask questions. He hasn't agreed to that. He agreed to come on the show. I don't know if he'll be comfortable doing a live show. All right. Garrett, do you ever save money to put into the market when it's down? So, in terms of sort of dollar cost averaging, 401k contributions, IRA contributions, whatever, no. I just put it in. I do have a separate fund for individual stocks, and it has some cash in it. I'm not waiting for a market dip. The buy the dip is a little bit, it sounds like a good idea, except that we don't really know what the dip is until we're past it. I mean, like we've had the market been down a little bit here. It's up today, I think. Let's take a look-see. Yeah, pretty good day in the market so far. Everything's positive, but ARK and Tesla, at least on my screen. No, that's not true. JP Morgan's down. Anyway, the thing is we don't know what tomorrow is going to hold. So you could buy the dip and it could crash 20%. And you're like, well, I guess I bought the mini dip. I bought the little dipper. I would have preferred to have bought the big dipper. We don't know when the big dipper happens until after it's done and we're back up. So in my portfolio of individual stocks, I'm more thinking of valuation than I am dips. And I'm toying with buying some, I think I mentioned this, some ETFs that focus on either a sector or maybe think emerging market value, small cap emerging market value, or something that's really beaten down in terms of valuation, not as part of asset allocation. I wouldn't include it in my asset allocation. It would just be, I would kind of view it as another individual stock, even though it's an ETF. I haven't actually done that yet. I don't know, maybe I won't. But in any event, Garrett, yeah, I don't really think of, of course I want to buy low, right? But I think of it more in terms of valuation. Like, if something goes down 10%, that doesn't make it a good buy. I guess it makes it a better buy than when it was higher, but it could still be overvalued, right? So I'm always looking at valuation with individual stocks in that fund. With the basic asset allocation, which is say 70% of our investments, just goes in, feed the monster, hope for the best. What else are you going to do? What? You don't like my knit hat? Bill, I don't know if that's a nasty comment. I can't tell. It seems like a pretty... Which hat? Are you talking about this hat? That says Marines on it? I don't know. I'm not happy about that comment, Bill, unless I misunderstand it. Okay. Tim says, they regularly say in financial channels that stock prices may go down on some dates because it's the option expiring, wondering how and why. Well, I guess that can happen. What they have the triple, I forget what it's called now. But you could see selling at expiration of options. I don't really care. I don't really think much about it. But yeah, I think it's a thing. All right. Have Fun asks a good question. With plenty of tax-advantaged accounts, 401ks, HSAs, IRAs, should these accounts be funded before a brokerage account? Do you recommend some percentage of brokerage over tax-advantaged? So if we're talking about saving for retirement, I would almost always favor the tax-advantaged accounts first. I suppose if you were worried about getting near-term access in an emergency, you could always include a Roth IRA in there. You can always take out the contributions, penalty, and tax-free. But yeah, that was my approach. I mean, we ended up maxing out and then investing in taxable accounts, but that takes time. We couldn't do that when we started. We didn't have enough money. Thomas asks, given the insane amount of debt government and people have, can the Fed really raise the interest rate? Can we sustain even 25 basis points increase? Well, the Fed can and will raise the interest rate. And we can sustain a lot more than 25 basis points. Of course, remember, at least for individuals, if you have fixed rate debt, like a mortgage, changes in interest rates are irrelevant for you, right? If you have a 3% mortgage and it's fixed, which I think most mortgages are, although I guess I don't really know that, but in any event, it's not a big deal. You have a fixed car loan, a fixed student loan. Yeah, it's not going to change. Our federal government, when it issues new debt, will be paying higher rates. That could be a problem. But runaway inflation would be a bigger problem, I think. I could be wrong. Okay. VJ, Rob, during the stock market downturn, if you are auto-investing regular intervals in taxable account, do you recommend a particular asset class mix? Are there any strategies you recommend? Well, I mean, I just have my asset allocation. Say it's whatever, 80% stocks, 20% bonds, maybe you have US total market, international. I just have the same, I don't change it because I don't change my asset allocation or my investments because we're in a bear or bull market. I hope that answers your question. Yeah, the asset mix for me stays the same. I might change it as I get older, but that's just because my investing horizon goes down by 1 day every day, or so I'm told. So yeah, okay. Mark, so this is Mark from the UK. He wants to know if I'm aware of a portfolio visualizer site similar to the, a site similar to that would use UK investments and whatnot, and I'm just not. Others have asked me that. If anyone is, please leave a comment in the chat. I'm not. Yeah. And I don't think, do they say anything about a different version of, like a UK version? No, not that I can see. Mike says, and he's the guy with the pink wig or hair or something, emerging markets are mighty cheap. So they're not just cheap, they're mighty cheap based on historical numbers. 5% average return over the last decade. Time for reversion to the mean? I tend to think so. Well, I can't argue with the logic. That's why I'm considering some kind of exposure. It's funny, you say, well, Rob, wait a minute. Weren't you just getting rid of emerging markets in your asset allocation, but then you're going to go buy it with individual stocks? Well, kind of. I haven't actually decided to get rid of them in my asset allocation. REITs would go first, and I might choose not to. But in the individual stock, I'd probably get very specific. I don't know what exactly, but it might be like small cap value or something. That's why when people don't like international stocks generally, because they've underperformed for whatever the last decade, they outperformed the first decade, 2000 to 2010, let's say, but they've underperformed since then. I don't know. To me, that seems like a good reason maybe to invest in them, not a bad reason. JJ says, by the way, sometimes I abbreviate your names, your YouTube usernames. If I am in the 22% tax bracket, does owning some small amount of municipal bond ETF or mutual fund, and then it cuts off, but I guess the question is it a good idea? Well, the way you would think about that is you could look at yields. So the same kind of fund in terms of credit, in terms of credit risk and duration, all things being equal, the yield on the mutual fund should be lower, right? Because you get the tax benefits. Well, you could figure out what your after-tax return would be in comparing two funds. I don't know if there are tools to help you do that. You could check it out. Maybe there are. My guess is I would probably at least be considering munis at that point. I'm considering them, and I don't know if might be in 24 this year. I don't know yet. But we'll find out. Tim says, I'm mostly on cash at the moment, I guess. Is 2022 a year to get into stocks or too risky? Well, yeah. He says, valuations mildly high, rate lift off, Fed tightening, maybe better wait. So, Tim, I don't think of it. So I think any year is a good year to get into stocks, right? I don't think of it in terms of the specific market conditions, at least with the overall asset allocation. I think one could make a good argument that they say the S&P 500 or whatever will be lower a year from now than it is right now. One could make a good argument that would be true. If I had to bet, that would be my bet. But of course, I don't know that that's true, right? More importantly, I'm investing for the long term. So I'm I'm dollar cost averaging into the 401k, the IRA, the taxable account, whatever. I'm going to be buying in cheap times, expensive times. I'm, trying to time the market. I think I've yet to meet anyone that successfully does it. You might hear people that do. I talk to people who do, who claim to, but when I start to interrogate them, and that's what I do, it always starts to fall apart. And usually it's that they really don't know what the returns are. Well, wait, when did you sell? What day did you sell? What did you sell? You sell everything? What were your taxes? You start to ask these, when are you getting back in? When did you get back in last time? When did you start to really drill down, and it just gets all cluttered, and there's no, I'm just not convinced that people can do it. So Dean says, I notice your lampshade is at an angle, a little distracting. So I get that every now and again. I don't know, Dean, if I don't know. Here's why I'll show you why it's tilted. Every morning, can you still see me? Every morning I come into the room and I do this. Now, I've just gotten out of bed. My back is always a little tight. I lean over and I turn the lamp on. And you see, it tilts it. I don't know what to tell you. Now, I can come back in, try to tilt it back, maybe. Yeah. Welcome to my world. What's your morning routine, Rob? Well, I lean over and brace myself against the wall and try to turn on the lamp. Wow. If you let Tim Ferriss know, maybe he'll have you on his podcast. Okay. Oh, VJ says, thank you for recommending Capitalize. My wife's rollover was smooth and seamless with them. Oh, good. Glad to hear it. Steve says, do you think ARK funds will go much lower? I have no earthly idea. Sold ARK-G, which is a genome, I guess, kind of fund, at a big loss, but still have the 3D printer fund by ARK. By the way, this one is index-based with a fee of 66 basis points. So Here's the problem that I have. My overall problem with ARK is Cathie Wood's approach to investing. I don't believe in it. Now, I could be wrong. I mean, let me just start there. She is more than willing to invest in companies that are losing money. And it's certainly true that some of those companies might just take off and just do incredibly well. And obviously, a lot of people invest in companies that don't make any money. I have yet to read about anyone who can consistently do well investing in companies that at the time of the investment aren't making money. I suppose you could look at angel investors and venture capital, but even most of their investments don't pan out. They just hit one or two home runs and it makes up the difference. Maybe that will happen with ARK and whatnot. But when you look at some of these funds, and you were mentioning ARKG, I know she has a 3D printer fund. I don't know the ticker, but we'll just use ARKG for a moment. Here it is. And if we go to the portfolio, so here's the top 10. What Teladoc is I know that's a big one that's gotten a lot of press. So let's just pull. I have no idea what their financials are like. Teladoc. Let's go here. I think this is the same company, right? I want to go to financials, and we're going to go to the income statement. So trailing 12 months, it made 1.86 billion. Its operating income, it lost 600 million. Its net income, it lost 800 million. Its EBITDA is irrelevant. And obviously its shares took a bath. So, this is a company I wouldn't even evaluate at this point. And it's not that it could, maybe it takes off and an investment in Teladoc turns out to be incredible. But I have no way to value a company like this. Its future it's just too dependent on things I can't possibly come to any sort of, agreement on with any level of confidence. And so I just picked one of her, from ARKG. I just don't believe in that approach. Here's the thing. This is my view. Well, everything I say is my view. Okay. When something does well or poorly, there's a narrative, right? Bitcoin goes, I've mentioned this before. I'm going to mention it again. Bitcoin goes up. Why? Why did it go up? Well, I mean, it's limited, right? Only 21 million, and I think several million have been lost forever. It's not fiat currency, which is a currency not backed by anything, and Bitcoin is backed by, well, in any event, that's beside the point. It can't, the Fed can't, start printing Bitcoin. Decentralized finance, that's cool, even though it's not really decentralized finance, but whatever. There's a narrative. So there's a narrative with ARK, right? The cool technology. And that would try to explain 2020. There's truth to all of that. All of the Bitcoin bulls, when they spell out the narrative, I agree almost completely with everything they say, except that's what's causing the price of Bitcoin to go up. Of course, it's gone down now recently. There's that saying that Buffett likes to say, when the tide goes out, we find out who's been swimming naked, right? Well, the tide looks like it's heading out. And the tide is fiscal and monetary policy. So at least for now, the government has stopped sending us checks. So there's that, at least for the most part. There's still some. And it looks like the Fed's going to start tightening. They're reducing bond purchases. It looks like they're going to start raising some rates. And I think that explains, by the way, it doesn't just explain, in my view, ARK and Bitcoin. It explains the S&P 500. Now, not 100%, but to me, it explains a lot of the price movements a lot more than the narratives that go with each of these things. That's my view. So I'm not a big ARK. I don't believe in that approach to investing. I don't think it's sustainable. I could be wrong. David, good morning. Welcome from Oregon. So Scott, I don't know if you asked the same question or someone else. What are your metrics when evaluating stocks? So I already covered that. I'm not a big metrics person. I certainly look at valuation. I look at the PE, I look at the price to book. Depends on what the company is. Like if it's a bank, it's price to book, it's pretty important. A lot of folks will look at your return on tangible equity. So the equity, which is assets minus liabilities, right? The equity of a company, excluding any intangible assets like goodwill or something like that. And I think that's, the interesting thing is to compare companies in the same space, right? So if you've got FedEx versus UPS, if one of them has a higher return on tangible capital, and I don't know if it does or not, I don't know, I haven't evaluated the companies. The real question is now why? Try to answer that question. Can you answer that question with any confidence? Sometimes maybe you can, sometimes maybe you can't. Sometimes maybe you can and you turn out to be wrong. But I don't do stock screeners. Yeah. I don't own, that's one of the reasons I don't own a lot of companies. I have 4. That's enough. That's hard to keep up with. I don't even listen. I should be listening to all of the earnings calls, and I really need to do that. And I haven't lately, which is bad. And I'm not a good investor. Justin says, I switched to your 6-fund portfolio as part of your annual rebalance. Now you tell me you're switching to the 3-fund. How come? Well, I think I explained it. I don't know that I'm definitely not going to 3-fund because I have small cap US stocks and I'm not leaving those. I'm probably leaving REITs because it's going to make managing my portfolio, including rebalancing, easier and less expensive. Emerging markets, I haven't decided on. Again, but if I leave it, it's because, remember, if I sell REITs, it doesn't mean I don't have investments in REITs because REITs are part of the S&P 500. They're part of total stock market type of fund. If I sell emerging markets, it doesn't mean I don't have emerging markets. They're part of VXUS, right, or other total international funds. So, but for me, I had the 6-fund portfolio for a couple of decades at least, and I was happy with it. Will it outperform a 3-fund or a 4-fund or the Paul Merriman 10-fund? I don't know. Yeah. By the way, you should have a firm grounding of why you're picking a portfolio. And if someone asks you why, and your only answer is because that's what Rob said, that ain't good. Not good. I know that's probably not what you're saying, Justin. But yeah, it's there's always trade-offs: complexity, simplicity, ease of rebalancing, minimizing taxes. Gage says, what type of account, Roth, brokerage, would you suggest B&D be held in? If I had the choice, I would probably put B&D in a traditional retirement account. I want my Roths to get as fat as a tick. I want to avoid taxes in the brokerage account. Some would argue that yields are so low now that bonds in a taxable account are not the end of the world. And I wouldn't argue with that. But for me, I'd probably stick with munis in my taxable account. Josh wants to know, what should the portfolio allocation be for someone 10 years from retirement but looking for aggressive growth? Well, aggressive growth is a term you'll hear, but I don't really know what that means. I would guess that people would put something like 80-20 or more stocks, 80-20 or 80% stocks or more as aggressive growth. That's probably what I would put. So if I were 10 years out, and I'd probably be at 80-20. That's what I would be at. I can't tell you, obviously you have to make your own choices. And I'd probably be working down. It's kind of what I am really, in a way, but working down to 70-30 when I retire. Yes, thanks, Quincy. If you have a question, tag me in the question so that I see it. I skip all of the ones that you guys, I'm curious, when you guys are, I don't know what the chat looks like for you guys. Do you see an orange? Like when you put at Rob Berger, it turns orange for me. I don't know if that's what it does for you. So like if it's not orange, I just skip it. You guys could be saying brilliant stuff and I'm missing it all. Displaced Hoosier. Hi, Rob. Do you include the current value of your home in your net worth calculations? Yes. How do you handle it given the crazy increase in home values? Well, there's 2 approaches. You could just put the purchase value or the purchase price, just leave it at that. That's what you would do if you were following generally accepted accounting principles, right? There may be exceptions where they mark to market, that's what they call it, the value of real estate, but I'm pretty sure, this is going back to my days at the PCAOB, and our focus wasn't GAAP per se, it was auditing standards, but GAAP was obviously an important part of that. I'm pretty sure they put that real estate gets reported at cost or market value, whichever is lower. I think that's the GAAP rule, but you CPAs out there can correct me. I just go into Zillow once a year and update it with whatever Zillow says it's worth. By the way, it's perfectly fine not to include it. Huh. People are saying the audio is choppy. I don't know. I hope it's gotten better. Let me know. I could talk more slowly. Does that help? Probably not. All right. Joe wants to know, can you convert index funds to ETFs at Fidelity? I'm going to guess the answer is no. I'm not seeing a quick answer to this. So you want to call Fidelity. The reason is that whole patent thing that I showed you earlier in the show. It doesn't expire according to the Boglehead form until 2023. I think that's what enables Vanguard to offer that. But again, I could be wrong. So please contact Fidelity for an answer. Dwight, thank you for letting me know the audio is fine, at least now. Hopefully it wasn't too bad before. Mike wants to know, and this is Mike. Well, I'll just read the question. Do you know Mike Piper? Answer is yes. It's been many years since he and I were together. I've gone to a personal finance bloggers conference for more than a decade. I think it's been a number of years since he was there, but when he was, I'd see him once a year. Great guy. His open Social Security calculator is the best I've found, and it's free. Folks should check it out. Well, let's go. So he is the blogger. He's a CPA. I don't think he practices anymore. He is the blogger behind this site, Oblivious Investor. There he is. And he's got great content. I don't know. Let's see. Let's see if he links to his calculator here. He has a book, Social Security Made Simple. I've not read it, but all his books are good, I'm told, and I've read, I think, one of them, maybe. Where can we find his calculator? I think it'd be a link in here somewhere. Oh, here we go. My very bottom. Let's see what happens when I click this link. I'm always nervous to click a link with showing you guys the screen, but this one worked out. So there it is. OpenSocialSecurity.com. I've never used it. Let's see here. Let's say we're married. I'll stick with male. Date of birth, fine. I'll just leave it there. Your primary insurance amount, PIA, is the amount of your monthly retirement benefit. Okay. If you file for it at your full retirement age. All right. I don't know. I'll just leave that. I'll say no. I'm just going to leave it all. I'll just leave it all here. What happens when we submit? So the optimal strategy is your spouse files for his or her retirement benefit in 2025 at age blah, blah, blah. You file at age 70. Huh. And that's the present value. I guess obviously making an assumption on life expectancy. Year by year amounts. Yeah, this is pretty cool. Thanks for mentioning it. There you go, guys. Yeah, Mike Piper's great. I highly recommend his blog and his books. So Benjamin wants me to read the Grant biography. Hang on for a second. Yes, I've got it. I will be reading it. I don't know much at all about Grant, and certainly not about his presidency, although I think I've read that it didn't go so well, but I'm not sure, and that could be wrong. See, this is what I mean, though. I mean, he's prolific, not Grant. I'm not talking, but this is a 900-page book, 965 pages. It's brutal. I try to read 25 pages a day. 925 divided by 25 will take me a while, but I am looking forward to it. But I'm reading them in order, so it won't be that long. Maybe by the end of the year. Okay, Addy, I'm sure I'm mispronouncing that. Can you compare two funds, which I'll mention in a minute, as a way to tilt one's portfolio towards growth? Okay, sure. So let's look at the funds. The first one, FCNTX. Well, that's Fidelity Contra Fund. I did a whole video on that one. And the other one is FSMEX, which is Fidelity Select Medical. Well, these are totally different, just by the name. So this is a medical technology and devices portfolio. Contra Fund is more of I'll call it a generic portfolio. Probably not the right word, but let me show you what I mean. So it's obviously growth, large cap. But when you look at the funds or the companies it owns, the usual suspects, right? It's interesting that it's got Berkshire in there. But in any event, well, actually, technically, the Contra Fund, I think the way they describe it, it's not a growth fund. It could invest in value, but it's obviously now predominantly growth. But when we compare this fund, we look at its portfolio, and I've never looked at this fund before, but its portfolio has to be dramatically different. So smaller companies, but still growth, right? But if we go down to the companies, right, it's all medical companies. So I would almost see, I would see Contra Fund as a growth fund. I'm not sure I would pick it as, I would look at others. I might look at QQQ. I might look at VUG, VUG, which is Vanguard Fund. This one I see more as a sector play. It happens to be growth based, but I kind of view this as more of a sector play than a fund. If my goal were to get exposure to large cap growth in the US, I would not use this fund. It's too specific. I wouldn't pick an industry specific fund. That's my 2 cents. And worth every penny. Okay. Good question. Dan, what do you think of buying NUSI and holding it for income? So I'm pretty sure we've looked at NUSI. My recollection is it's a covered call ETF. I could be wrong. Probably I am. So it's oh, that's right. It's the nationwide. It's risk managed, which in and of itself doesn't really tell you much. So I'm going to pull up the nationwide. Here it is. By the way, I'm generally not in favor of risk managed anything. I want to manage my own risk. That's not a very pleasant website. What is that? Okay. Oh, wait, maybe if I'm going to take it off screen for a second. If I hit for individuals, that doesn't help. Really? Come on, nationwide. All right, one more time. See, unfortunately, Morningstar doesn't give you like a good sort of narrative description. Yeah, and the nationwide website is just, let me try something else. And then we're going to give up. Option collar, yeah, so option collar ETF. This is, I'm reading from a site, I'm reading from Optimized Portfolio. Covered call writers own the underlying and collect premium on the option, and the buyer of the call, blah, blah, blah. For example, blah, blah, blah. Yeah, I'm just not I just think this is unnecessary cost and expense, or cost and expense, cost and complexity. He does, look, he's using Portfolio Visualizer too, and he's comparing several of them. I've just never felt a need. Okay, 2 more funds. LOPA. What do you think of these 2 funds in a 401k? And the funds are, the first one is TRLGX, large cap growth. And the second one is one we just looked at, right? FCNTX, right? Oh, I always get the V's and F's. It's got to be some sort of learning issue. That's contra fund. What? So we've looked at contra fund. I think if you're wanting a growth fund, I think it's one of many that I would consider. I'm not a fan of the expense ratio, so I'd probably pick an index fund. This one, again, kind of expensive, so same thing. Portfolio. It is a growth. It is large cap. Contra fund is about the same, right? Yeah. So they're very similar. And if we go to portfolio, I'm sure they're going to be very similar. A little different in terms of order and allocations. We could look at the history, but these are very similar funds. I'd probably go with an index fund. Of course, this is in a 401k, so you may not have an index fund. So I'd probably go with the cheaper one, which is T. Rowe Price. But you could put it in Portfolio Visualizer and you could look at the history. The problem with that is you don't know that history is going to repeat itself. Patrick, best place to park money for an emergency fund, checking account, savings account, money market. I mean, there are pros and cons to different approaches. Frankly, I think just an online savings account. I know the rates are terrible, but it's an emergency fund. It's probably the best. A money market is okay if you want to. You don't want to. If you want to keep it like in your brokerage account, you just keep it in a money market fund. I mean, they're not going to pay as much typically as an online savings account, in my experience. Yeah. I probably wouldn't keep it in a checking account unless it were an account solely for that purpose. So like there's some, let me show you one. So there are all these tech companies that have started banking services where the tech company itself is not a bank, but they partner with the bank. And what the tech company does is they provide the sort of front-facing app that you'll use, and they provide the debit card. But they're not the bank. So Chime, which you may have heard of, is an example of that. Chime is not a bank. They partner with an FDIC insured bank. They're just the app and debit card. Another one is called Onjuno. And here it is, which they've really gone into crypto, which I don't really care for. But yeah, they've really gone full crypto, haven't they? But they have just a standard, they used to, a standard like checking account. Yeah, they're FDIC insured. But man, trying to, interest rates. Yeah, they're currently offering this 1.2% sort of bonus. They call it a bonus rate. And it's being paid by Onjuno, so that could change. Now, I do think, now that I think about it, though, I think there's a limit. I think it's limited to like $5,000, so that may not work. Yeah, I mean, yields are low. I don't know what to tell you. And they're probably going up. We got that to look forward to. That's Life says, I have been busy and not able to watch your videos on investing in a falling market. Could you please, I misunderstood. Could you please give a summary? Well, my investing is no different. I just keep investing the same way. I don't do anything different in a falling market. And, opinions on keeping 3 months emergency fund. Oh, here we go. They're giving us an option of where to save our emergency fund. This is from Trap. In HYSA, then 3 months in a stable coin. Well, I would not do 3 months in a stable coin. I know it gets 9% APY, but there will be a reckoning in the crypto space. Don't know when, but there will be. So I would not put my emergency fund in a stable coin. That's just me. What's HYSA? Oh, that's just high yield savings account. That's not a ticker. Well, I agree with that part. I'm just not a fan of putting my emergency fund in block FI. I'm curious, what stable coin are they giving? It's not Tether. Well, what do they give? 9%. Oh, USDC. Yeah, up to 40,000. You know, the question is, how are they doing that? Who in the world, think about it, who would you borrow? So you're going to borrow. Would you borrow at 9%? Why are people borrowing at 9%? That would be my question. Maybe there's an answer. I mean, they're using it, I guess, to buy other crypto. I don't know. Anyway, I would not put my emergency fund there. No. So Johnny says, not many options for international funds in my company's 401k to build a 3-fund portfolio. I do have Fidelity, and then I can't read it. 500 index fund, Fidelity, total bond market. FSPSX is in there. FSPSX. Franklin Street, no. Fidelity International Index. Well, what's wrong with that? For international. 3.5 bips. It's cheap. Portfolio is all international, or almost all. Region, yeah, international. It's got, so this is mainly developed. It's not emerging market. You can see here, Europe emergence has got 0.07, Asia emerging 10. So effectively no emerging. But I mean, if that's what's available, I wouldn't lose any sleep over that myself. So if that were the only international fund in my portfolio, yeah, it's a developed international index fund, meaning developed countries, not emerging markets. I personally would be okay with that. So RA asks whether you can transfer an HSA from one provider to another without incurring taxes. Absolutely, I've done that. All of my jobs where I've had an HSA, they've had it at places that weren't great. And by that, I basically mean they didn't allow what's called first dollar investing, meaning you had to have 1,000 or 2,000 in their cash account. And then you could invest anything after that. Well, when I left, I'm like, I don't want to keep it there. I want to invest 100% of my HSA. So I moved it. And yeah, it's like transferring an IRA or, same kind of thing. Yes, and please do tag me. But I see a reference to Eric, who didn't tag me, and I see above that Eric's question. So I'll go ahead and read it. Rob, wife and I retired. Congratulations. Little over $500,000 invested in Vanguard, 50% VFIAX, which I'm pretty sure is the S&P 500 mutual fund, I think, and 50% divided between STIPs, which are tips, and VGSH. Short-term treasuries. All right. We both have started Social Security and have a small pension. What do you think? Well, so it's a 50-50 portfolio. I would put that in what, for me, so let me back up. When I'm thinking about asset allocation and retirement, I'm thinking, how old are you? Do you have any debt? What percentage of your investments do you need in year one to live the way you want to live? And all of those questions could lead to different asset allocations, right? Do you want to leave money to your children or charities or whatever? So, but as a general rule, with a gazillion exceptions. I see stock allocations in retirement somewhere between 50 and 75% as a general rule. You're at the low end of that, but you're within that range. I personally would not put all of my stock allocation in the S&P 500. And let me just make sure that VFIAX is the S&P. It is. I personally would not put all of my eggs in the S&P 500 index basket. By the way, Warren Buffett would. So he's a pretty smart guy, I've heard, when it comes to investing. I would prefer probably a total U.S. stock market and some international exposure. That's my preference. I like splitting between tips and, in your case, treasuries. I'm not sure I would go short term, even though I understand the risks right now with interest rates. Again, that's my preference. I'd probably go intermediate term. I'm not saying what you're doing is wrong. That's, I don't know why I'm hedging everything. You guys are asking my opinion. So I personally would go, I would have more equities than 50%. But again, 50% can make a lot of sense depending on your overall circumstances. If you really want someone to evaluate something for you on a fee basis where they dig into all your details, someone like Mark Zoril or some other hourly based financial advisor who isn't going to manage your money but could look at it, I would highly recommend that. But those are my thoughts. Okay, now I've got to go back down and figure out where I was. Here we go. How are we doing? I don't know if you guys knew this. Some of you were there, but on Monday night, I did another live stream, and I might do it again next Monday. It's amazing. It's like never ending, the questions. I get it. Okay. Jason, he's middle age. He's a physician. $6 million in cash to invest. A balanced investor until 2019 when it became clear what COVID would do. Let me just stop there. I'm still not clear what COVID's going to do, but I have seen what it's done. Anyway, misread the Fed, of course, terrified to buy back in. Yeah, I get it. I mean, I'm generally lump sum. You're middle age, so I'm going to say you're in your 40s. You got what, 20 years before you retire? If it were my money, I'd just invest it, recognizing that I could take a bath. If it concerns you, dollar cost average over a year or two. Yeah. But you're never going to know ahead of time which one will work out. And in hindsight, it'll be, well, of course, that's what happened. Of course, so obvious. But you'll never know. But yeah, I hear you. But, on the bright side, it's a good problem to have. Lisa says, is this a good time to buy low with some of my bonds? Do you mean sell bonds to buy stocks? I'm not sure. Maybe if you could clarify that for me. I'm not quite sure what your question is. But if that's your question, the answer is I have no idea. There's no way to know. I don't know what the market is going to do by the end of the day. Look, it's gone red, some of it already. I mean, look at this. You probably can't see much of this. It was all green, right? Apple was up like 2%. Look at this. Let's go to one day. Look, it was all the way up to 163. It's now down to 160. I don't know what it's going to do by the end of the afternoon. S&P's flat now. My bank stocks are in the red. Yeah. There's just, the problem with financial media is they can make you believe that people actually do know what's going to happen. So-and-so, who correctly predicted the tech bubble and the Great Recession, now says, and I'm thinking, well, wait a minute, because I'll go back and research it. You're right, they predicted the Great Recession for like 2.5 years. So they were wrong until they were right. It's like me predicting that it's 5 minutes till noon. I'm wrong most of the time, but eventually I'm going to be right. And they play it up. The reason they play these people up is because it gets clicks. People want to read it. I mean, this person can predict the future. I won't go into religious issues, but if any of you are a student of the Bible, regardless of your religious views, and you read what some would call the New Testament, and particularly the Gospels, Matthew, Mark, Luke, and John, which, by the way, weren't written in that order. But at the time they ordered the New Testament, they thought they were written in that order. Mark was actually the first one written, at least most scholars say. In any event, not really relevant for my point. There's a guy, kind of the main character, if you will, in those 4 books, who talks about people, but you always want to know the future. You're always trying to predict it. We haven't changed. Okay. I don't know really where that came from, but it came from some deep, dark place. Okay. All right, I think I got that question already answered. Keith, I want to balance out my retirement portfolio with bonds, all right? I already have some B&D, that's just Vanguard's total U.S. bond portfolio, a little bit of treasuries, a little bit of corporate, a little bit of asset-backed bonds. Securitized is the fancy word I think they use. I'm scared to be buying bonds right now, given the Fed moves. Thoughts on when to buy? Well, if you're scared, you think inflation's going to go up and interest rates are going to have to go up, you might buy tips, right? If you think inflation's going to be higher than people expect. But I get it. But the thing is, if interest rates go up, stocks will come down. I mean, long term, they'll be fine. But I get it. I don't know what to tell. I mean, you have to decide what kind of investor you are. And I'm just a investor. Here's my plan. I don't care what's going on. Now, I did go short term with some of my bonds, but I'm fixing that now. And I'm not sure that was a smart move. I don't think it really cost me much. I don't think it saved me much. So some could say I didn't follow my own advice there. I suppose that's a fair criticism. But Keith, your point, we don't know. We really don't know what interest rates are going to do. The market thinks they're going to be raises. The Fed's going to raise rates this year, and that seems sensible to me. But we really don't know what's going to happen or what the impact on bonds. And you're talking quarter basis, 25 basis points at a time. In the short term, that will cause, let's say, an intermediate term bond fund to come down. But over time, it'll benefit from the higher yields. So there's pros and cons. Long-term investors. Scott says, do you think legislation will be passed where capital gains and loss harvesting are completely eliminated? And investment risk is either rewarded or punished? I don't believe that, Scott. I don't even know of any. Are there any proposals for any of that? I don't think so. But I don't know. So Richard says, love the show. I would like to know your thoughts on my 6 ETF portfolio. Well, okay, let's take a look-see. We'll just go through them quickly in Morningstar. First one is BTZ, credit allocation. I love these names. Like, I don't know what that is. I guess it's a fixed income of some kind. Look at that. So it's using a short long strategy. You can see that because the net is 126, right? So they're long here, they're short on cash, mainly corporates. So, this could be a great fund. It looks like it's high yield. This is not the kind of fund I've invested in. I just don't like to get this fancy. What's its yield? It should be higher than 739, but that's got to be that's got to be based on some options strategy. I'd have to dig into that one, which we could. You guys are too fancy for me. I'm from Ohio. We don't get into this short, long, covered calls, collars, wheels, butterflies. It's like 3 yards in a cloud of dust. That's how we should invest. Anyone know that reference? I'm sure somebody does. May he rest in peace. BlackRock Credit Allocation Income Trust. To provide current income gains, cap, blah, blah, blah. Investment by investing under normal market conditions, at least 80% in credit-related securities, including but not limited to investment-grade corporate bonds, high yields, bank loans, preferred securities. Yeah, it uses derivatives. So I don't know. This could be a great fund, but it's far too complicated for me. By that, I don't mean that I couldn't dig into it and understand it, but I generally just don't find a need for that kind of complication. Maybe it serves a purpose in your portfolio, though. So that's great if it does. So Vanguard Real Estate, that's a REIT. I like it. I've owned it. I own it now. Not the ETF version, but VYM, which is high dividend yield. I think this is a good fund. I would use this as a way to tilt a portfolio if you wanted to. Should be value, right? Yeah. If you wanted to tilt your portfolio towards value, I wouldn't use this as my core US stock fund. It would be, hey, I want to tilt towards value a little bit. So maybe in addition to FTI or VOO, or VTI or VOO, I might have this. VONV, which is Russell 1000. So this is, if we look, you can see this quite clearly, this fund, if we go here and look at weights, right? So it's got some mid cap, but also there's a lot of overlap between this fund and the one we just looked at. Something to keep in mind, not a complete overlap. Let's go back for a second. We go back to this one. Yeah, see, it's some overlap for sure. That'd be something to think about. IJR, which is small cap, so that's fine. And SLYV. So I don't know why you have these two small cap funds, IJR and SLYV. And they're not identical, but they're both covering roughly the same thing. It's a question, maybe one's, well, these are both ETFs, so they wouldn't be in your 401k. I started to say, well, one could be in your 401k and another not. Yeah, so that's it. You might be able to simplify it. Of course, a big question are what are your percentages in all of these? But I think these are all reasonable funds. The BTZ is one that could be a great fund. I generally just stay away from those kinds of funds. Maybe I shouldn't. Maybe I should look into it more. Shredder. Which security was it that lost 25% over 20 years earlier on in Portfolio Visualizer? And can you discuss? I don't remember that. Happy to discuss it if someone can remember what security that was. I don't know. Can't remember. Do we look at one? 25%? I don't know. Okay, that question I answered. That one I answered. So Grant wants to rate his portfolio. Let's just do this real quick. I think I recognize most of these. So he's got, or she, Grant, he, 25% in VOO, right? So that's just S&P 500, all right. 25% in VO, which is mid cap, all right. 25% in VB, which is small cap. So let's stop there. So 25, 25, 25 in basically US large, medium, and small. So what that's doing is that's 75% in US stocks, and it's tilted towards mid and small cap. Excuse me. If you just had VTI, and I can show you this. So 25, 25, 25, right? Remember that. Now let's compare that to total stock market. And then come here and go to weights. So Grant's portfolio has 25% small cap. This has 9. The market, we just wanted to mirror the market. It's got 9. Mid cap, right, has got, I want to say 19. Is that right? I think so. 14, 19. I was an English major. Just remember that. So he's overweighted mid cap by a little, 6%. So that's the effect. I think it's within a reasonable range of things to do, right? And, other folks will just overweight the small cap, have this VTI, so you've got some mid cap, and then overweight the small cap with a small cap fund. But I can't say that's unreasonable. All right. And then VTV, which is Vanguard value. So that's interesting. It's only 5%. So it's not a huge tilt towards value. And I think it's large cap, right? Yeah. But that's a very common thing to do, is to tilt towards value. I can't argue with that. VOE, is that an energy fund? I have no idea. Oh, it's just mid cap. Well, he's just tilting back now 5% mid cap, so that's tilted towards value. And then I might have the percentages off a little bit. I'm trying to read his text. And then small cap value. So it's basically 90% US stocks with tilts towards mid and small cap and tilts towards value, and then 10% in international. That's an interesting portfolio. No bonds. So, obviously an extremely volatile portfolio. But if you were 100% stocks, I can't say that's a bad approach. It's a somewhat complicated approach. But you could how would you simplify that? So we could use VTI in place of the first three. You wouldn't have as much small cap exposure or as much mid cap, but you would have exposure to both of those. So you're trading that exposure for a simplified fund that takes three funds and replaces them with one. Not saying one's better or worse, they're just different. Those are the pros and cons, right? And then the value, right? Because you could just do Vanguard value. I'll show you this in a second to make sure I've got the right fund. Yeah, so this one wouldn't have any small cap value, but you could go with like a Vanguard value index that gives you value, at least large cap, mid cap. I don't know if they have one. I'm sure you could find a value index fund that includes small cap. And that would replace the other three funds. You could. Again, you wouldn't be able to decide for yourself exactly what the allocation would be. That's always the pros and cons. You're giving up one for the other. But I can't, I think it's an interesting portfolio. I can't, yeah. All right. Eric, what do you think about STIP? Is that the Schwab tip fund? I don't even know. Oh, iShares. I think it's a good fund. Here it is. It's short term. And we can look at portfolio to get that duration, 2.5. I don't know where short becomes intermediate, maybe around 5. I'm just guessing, maybe not, 3 or 4. But you see it's limited. That means its interest rate risk is limited because of its duration. If interest rate, well, this is a TIPS fund too, so it could react differently to inflation, but interest rates and inflation are often linked, right? But in any event, it's a short term, and I'm sure it's cheap, but let's confirm that. Yeah, just 3 bips. So perfectly good fund. I like it. How are we doing on time? Man, 2 hours is almost up. Ooh, exhausting. Jim says his nephew got a $10,000 bonus, wants to save towards house purchase within 5 years. He asked my investing advice. First thought is an I bond, but 5 years seems a long time out of market. Well, an I bond may not be a bad choice right now. It's locked for the first year. You're gonna get 7.12% for the first 6 months, guaranteed. And then I'm guessing the inflation adjusted rate, which comes up in what? Is it March or whenever? Is going to be pretty high unless something really unexpected happens with inflation. So you're going to get a good year of rates. And if you pull it out after that, but before year 5, you get tagged for 3 months interest, but still for a risk-free investment, that's really good. And if the interest rates stay high, depending on what inflation does, you might keep it in there longer. And if they go low, you just pull it out. You'd still be better off, even paying the 3-month penalty. So it's not a bad idea given the amount. It's 10,000, right? I mean, like we looked at an earlier question where I think someone had 200 grand. Well, you can't put 200 grand in an I bond, at least not quickly. But for 10,000, Jim, that might be what I would do. I certainly don't think it's a bad idea. So Gage wants to know what the pros and cons are of tilting a portfolio towards real estate. Well, I've done that for years. I mean, you can always go to Portfolio Visualizer. I don't know how helpful this will be, but let's take a look. So I always include REITs as part of my stock allocation. So let's imagine a 100% portfolio with stocks, and then be under alternatives. Yeah, REIT, we'll do 90, 10. My guess is this portfolio is going to crush it, going all the way back to 1972. No, I'm wrong. Oh, there you go. I'm surprised. That really surprises me. Of course, we could pick a different time period and maybe we'd get a different result. Of course, it's only an 8 basis point difference. And if we look at, they're all pretty comparable. Obviously, some years better and worse depending on the portfolio. This my thinking on REITs, maybe this shouldn't surprise me. My thinking on REITs was that they wouldn't necessarily increase my overall return, but they would increase my diversity and maybe soften a little bit of the volatility. You kind of see that with standard deviation here, although, boy, it's not a big difference, so it's not a lot. But again, we're just cherry picking. I mean, let's randomly pick a different year. I don't know how random that was, but I picked a different year. Is that right? 94. How far back did it go before? Because those numbers look identical. Yeah, it was limited to 94. So we got to pick a random date. 1982 won't work. Let's pick 2000. Actually, let's just get crazy and pick 2006. Yeah, see now 100% stocks pays off. Of course, that's right before the real estate crash and in a period of time where stocks did really well. Of course, REITs haven't done so poorly. So, but this is kind of consistent with my thinking back when, the returns are going to be somewhat comparable, but it adds a little bit of diversity. That was my thinking. So there you go. All right. I'm going to skip through any non-retirement questions or investing questions. I don't know. I haven't gotten a single physical fitness question. I know this is an investing channel. So, Stephen, you're from Ohio. Love it. How do you feel about microcap ETFs? And specifically, iShares Microcap ETF IWC. I like microcaps. I'm not familiar with this fund. A little expensive for me. It's 60 basis points. Certainly a valuation well below the S&P 500. I like this kind of fund in concept. This would be the kind of fund that I might put in my individual stocks. I'd probably try to find a cheaper version that covered basically the same sector, same asset class, if you will. And I used to own Bridgeways years ago. They have a microcap fund, although it's actively managed. In the microcap space, this is something I'd have to think about. And in the microcap space, it might make sense to have an actively managed fund. I don't know, or at least you might have a better chance. I don't know how well they've done versus the indexes, but I like the concept. Super Zig, I'm kind of skipping around here and I'm sorry about that. But when retiring early, let's say 50, how do you recommend going about getting health insurance? Well, we bought it through our business, but if I didn't, I'd just go through, I don't know that I'd go through the exchanges unless you could qualify for subsidies. But I might just reach out to Blue Cross or whichever one you wanted and get a policy. Yeah, it ain't cheap. That's for sure. All right. Well, we were about out of time. So again, I will have timestamps. I've got someone helping me, Matt. He's great. Hopefully later today. If I can, I'm going to do another one Monday night at 7. No guarantees, but if I'm going to do it, you'll see it come up like a couple of hours ahead of time on YouTube. So if you subscribe, you'll get a notice. I know I've yet to do one of these shows and actually get to all of the questions. I'm sorry, that's just the nature of the beast. You can subscribe to the newsletter. There's a link below the video. It goes out on Sunday mornings. I think it's pretty good. I want to figure out ways to make it better. But I try to find useful, interesting things that will help you be better investors, help you in retirement, whatever. So that's fun to put together. And I guess that's about it. That's all I got. So thanks for watching. As always, you guys are terrific. I appreciate it. And maybe Monday night, again, I'll get that set up a couple hours ahead of time if I can do it. And worst case, I'll be back next Thursday at 11 a.m. Eastern time, Lord willing, and the creek don't rise. So until then, hope you have a great week. And remember, the best thing money can buy is financial freedom. And definitely not a complex covered call ETF. I don't think.